Welcome, everybody. If you tuned in last week, we presented the 2025 Conscious Business Forecast and talked a little bit about conscious business growth and what's happening. For those of you that I don't know, my name is Terri Maxwell, and I have a portfolio of companies called Share on Purpose. And one of those companies is Shiftco. And in Shiftco, we train difference makers or conscious businesses how to grow their business and maximize their impact. Three times throughout the month, we bring guests to you to talk about various topics to help you grow your business, to help you understand what's happening in the marketplace. And today's guest is somebody I've known for over a decade. Loic is not only our wealth advisor, but he's somebody that I trust implicitly with helping make sense of what's happening economically and as much as you can, really understanding some of the dynamics at play. So, Loic, thank you so much for coming today. And I know we talked about the topic, but I want to have you share some of your insights about what's happening in the economy. What are the goods? What are the things you're concerned about? And then what can we do differently in our businesses? So take it away.
Sure. Well, Terry, thanks for having me. It's always a pleasure to talk to your crew. So like Terry said, my name is Loic LeMener. I run a wealth management firm here in Dallas. A little hello from the attorneys real quick. So what I'm going to start with is some market data, and then we'll shift over during the second half on to explain what you can do as a business owner and inside your business. So one of the things I think has happened over the last really 15 years is we've been in a pretty benign environment in terms of the capital market. So all this chart is the blue line is how expensive or cheap the US stock market is. The black line is how expensive it's been on average. And there's an old saying on Wall Street that good markets only teach bad lessons. And for about 15 years now, really since the bottom of the financial crisis, which was on, believe March 9th, 2009, the market has been in a pretty uninterrupted march upwards. We had, a pretty scary but very quick decline during March of 2020 during COVID, and then 22, the markets fell about 20%. But really, if you've been an aggressive investor of all kinds, whether it's been real estate, the stock market, et cetera, you've been rewarded over the last 15 years. I have this quote up here by Ray Dalio at the very top of the slide, because I think it's one of the most important concepts in investing, which is, the greatest mistake the individual investor makes is to think a market that has done well is a good market rather than a more expensive one. I am of the school of value investing, like the Warren Buffetts of the world. I view this as a rubber band that is stretched and is aching to go back to average. And so the better things are, the more highly things are priced, the more we should be cautious. And I guess I'll stop there, Terry, and see if you have any questions. But do you have any questions?
I want to crystallize this because I know we know what you mean by more expensive. So when you say more expensive, you're talking about the share price, what a share is worth, whether you're investing in mutual funds or stock. And what you're saying is that even after COVID, where we saw that dip, it bounced back. And since the 2009-2010 economic crisis, for the most part, all of your investments have gone up, but they're so high right now, they're priced so high on a per share basis that we need to be cautious that they may not continue to go up. Is that another way to say it?
Yes, exactly. All of investing is a ratio between price and value. Price is what you pay, value is what you get. And why a lot of people have horrendous investing careers is because they're only looking at the price, and they value, the price is a black and white number that you see on your statement or your computer screen every day. Value is this very nebulous thing that is an opinion. It's squishy. It's never an objective number. It is a subjective opinion. However, the bigger you go, like when you're looking at things like the S&P 500, you can do a lot of shortcuts to determine just ballpark how expensive things are relative to the value. So that, you know, that's what a PE ratio is, right? The price that I'm paying versus the earnings that I'm getting. You can do this Q ratio is a balance sheet driven. So it's how expensive are my stocks relative to replacement value. So it's always a fraction. What I'm saying is, even though the economy has, for the most part, been good the last 15 years, we're certainly a bigger economy, more valuable economy than we were 15 years ago. The price relative to that value has increased dramatically to a point where now we are the most expensive of all time.
And the most expensive of all time, I want to put a pin in. And I also want to connect it back to the founders that are tuning in, because ShiftCo serves founders. Why this matters isn't because of your investment alone. It's that if the markets do go a different direction, then businesses make very different decisions. And we'll be talking more about that in a minute. But I want to broaden your lens. This isn't just for your personal investments. It's also understanding what's happening in the economy and how that may affect your business. So, Loic, you might want to move on to the second topic, but I just want to put a pin in that point.
Yeah. And then I'll skip this. This is just another way of seeing kind of a similar thing, which is stocks are cheap. The horizontal axis is how expensive stocks are. The vertical axis is the forward 12-year return of the markets. Obviously, we're way on the right side of this chart. So if you expect normal 9-10% rates of return, which after big bull markets, people's expectations go up, not down. So the average investor today expects a mid-teens return from their portfolio. And yet what the math says, because we're starting from such an expensive point, that you should expect, you know, very low single digits, possibly negative returns over the next 12 years. So, you know, to be up here, to be around the 10% mark would be far from anything that has happened in history.
In history, not just in the last decade, but in history.
Correct. Yeah. This chart goes back to 1928. I'll give you a fun fact. There's a trio of researchers in England that went through newspapers to create good data for stocks, bonds, and cash going back to 1900. We have that for 24 developed countries. So that's 3,000 years of history. In 3,000 years, there has not been a single stock market the one firm that threw out this stat considers anything above 2 standard deviations, which is just a way to measure how extreme it is, a stock market bubble. We have never had a stock market bubble not go all the way back to average valuations in 3,000 years of developed world history, which today, from today's starting point, would imply a 60% loss on the S&P 500. Now, I will warn people, valuations are not a timing mechanism, right? You could have told, and I did tell clients that the markets were expensive 5 years ago, and they have continued to go up. However, you have to be mindful of the rubber band effect. The more stretched the rubber band, the more likely it is to snap back at a certain point. Or the other analogy I use is, it's kind of like climbing Everest. If you're a third of the way up and something wrong happens, you're probably pretty safe. You can go back to base camp. If you're at the tippy top of Everest and something goes wrong, you're probably in a very bad situation very quickly.
Excellent point.
This is, I think, really important to cover because, again, this has a lot to do with today's conversation with the new administration, as well as how they affect the markets and just the general economy. There's something in the investments world called the Kalecki equation. That's just a fancy way of saying all the value in an economy can only go into one of 4 buckets. It can go to it can go to corporations in the form of profit margins. It can go to households in the form of savings. It can go to the government in the form of savings, or it can go to foreign entities. And what we find over the last 20, 25 years is that 2 of these groups have done fantastic and 2 of them have done horrible. So the 2 that have done fantastic are namely foreign countries. They've done fantastic. I put it in red because it's fantastic for them. We have made China a much wealthier country. That's not necessarily good for the US. The other one is corporations. Corporations profit margins the last 25 years, that's the blue line on this chart. The blue line was very very well behaved between a high and a low that stayed true for about 50 years, and then something happened in 2000 and it jumped up, and we have been at much higher profit margins since then. The red line is the cumulative dis-savings of US households and the government, meaning US households save, but they don't save nearly enough. And then our government is doing the opposite of saving, which is dis-saving, which is running a large deficit. And these two lines are about as correlated as you'll find anything in the economy. And the bottom line is, the reason why American companies, and this is not only public companies, private companies, this is everybody who tries to, make a profit for a living. The reason why the profits are so large at a national level is not because today's, CEOs are smarter or technology is better. It's literally the flip side of the coin of the government spending. We have never had, except for World War II, we have never had 5 straight years of a 5% plus fiscal deficit, and we just have finished a 5-year, 10-year, and that includes the Great Depression. So if our government tries to balance the budget while being a very healthy thing for the country's finances long term, de facto it is taking money out of the other 3 buckets, because this equation has to balance at all times.
So I want to drill down on a couple of things here, because it's easy to get lost in these points. So the first point that I want to make is corporate profits are through the roof, more than they have ever been. And for those that listen to the Conscious Business Forecast, where I talk specifically about the friction between shareholder capitalism and conscious capitalism and stakeholder capitalism, one of the reasons why there's so much friction is because corporate profits have been so high. So that's what you're saying, is the blue line represents the magnitude of how much profit corporations are making. Is that correct?
Correct.
The red line is a combination of household savings, whether or not households are saving money, which if inflation is happening and their budgets are compressed, we know that they're not saving, which is one of the reasons why it's high. In addition to that, what you're also saying is that traditionally governments have not been saving and they're running at a deficit, but part of what they are doing is they're actually putting money into corporations' profits because they're spending more than they're taking in tax receipts. Is that correct?
That's exactly right. Think of the government as the biggest client in the national economy, and it's spending like a drunken sailor.
And that will obviously tie into some of the new administration's policies here in a second. And as I know that will be part of what you discuss. But from a standpoint of economic momentum, this is I'll be the one to say it because I know you can't say something like this, but this is a recipe for disaster. Because economically, we have 2 things that traditionally correlate very closely, but they are both going in a direction that is not the direction that's going to be healthy for the average person who is trying to invest and the average person trying to build a business. And those are my words, not yours. Anything you grossly disagree with there?
No, not at all. And I would put it another way, which is, we have already made our bed in an unsustainable dynamic. So either, let's say politicians got religion and they decided to balance the budget, that is literally pulling money away from the rest of the economy, which would be a healthy thing for our national deficits and debt but it would compress these profit margins back to where they were during this 50-year run that was much more normal, and it would be really hard on all businesses, but especially the stock market.
And so if we think about that, if the stock market starts going the other direction, or corporate profits start to go the other direction, then corporate spending slows down, hiring slows down. And then the next thing you know, small businesses are affected, consumers are affected, then they don't have money to put back into the economy. And that's the potential, that's the recipe for disaster that, again, my words, not yours.
Yeah, I would say the last 15 years has been an upward spiral where all these dynamics have reinforced each other, but in a very unhealthy way. And if something triggers, and again, none of this is, I'm a firm believer, and I'll express this a lot during the second half of this presentation. I'm a firm believer that nobody can time this with any degree of precision. But when something, pricks the bubble, whatever analogy you want to use, and the dynamic starts reversing, this could be really, really painful in the other direction.
Excellent. Thank you.
Sure. So, this is one slide on our government debt. We all know it's out of control. This chart is the interest payments. So not only have we increased our national debt, but then with rates going up recently, the rate on that debt. So every day that a treasury bond matures, it might have been a 2% treasury bond, and it's getting reissued at 4.5%. So you're more than doubling the interest charge on that bond. The deficit for 24 was 1.8 trillion. National debt's 36 trillion, which is 123% of GDP. But that's not the whopper. The whopper is if you take the present value of all of our entitlements, that's Medicare, Medicaid, Social Security, et cetera, and you treat it like a corporation. So you take a present value of that. The present value of all entitlement programs is closer to $200 trillion. So that is an unpayable promise to the American public. Now, the good news is we've been doing this for 800 years, right? There's a book by Ken Rogoff, a Harvard professor, where he goes into sovereign debt crises for the last 800 years. And, governments over and over, we had, I think, something like 32 debt crises in Athenian days. We all know how the Roman Empire fell through largely inflation and debasing their currency. We have long history of seeing the good way to handle this, which Ray Dalio would call that a beautiful deleveraging, or a bad way, which is kind of kick the can down the road and all of a sudden, all hell breaks loose. And so what's concerning to me today is there doesn't seem to be a serious conversation in Washington like there was at the end of World War II to say, we have a problem and we need to address this because it's getting out of control.
And go back 1 second, because I know you skipped past that the total deficit is 123% of GDP. In common language, what does that mean?
So GDP is a measure of the size of the economy. And it's basically, you can measure it different ways, but one way to measure it is everything bought. Another way to measure it is everything sold. Think of it as, if you're thinking of a corporation, it's the top revenue line. So you're measuring your revenue, not even your profits, your revenue compared to your total debt load. And today in America, our total debt load is 23% greater than the revenue line item for the entire economy. So, the rule of thumb, again, going back to Rogoff, one of the seminal kind of stats that came out of that book was once you get to about 80 to 90% debt to GDP ratios, that's when national debts really start impacting the growth of an economy and slowing it down. And of course, we are way beyond that. We were around 90% not that long ago, but we spent about $10 trillion getting ourselves out of COVID, generating inflation. And so here we are, 5, 6, 7 years later, and we're at 123% debt to GDP.
And in addition to that, what we have promised to the American people is almost impossible to follow through on.
I would assume part of this 200 trillion, that's kind of double counting. There's the on-balance sheet debt. I'm assuming that $200 trillion includes the roughly $36 trillion of national debt we have. But even if it does, it's the small portion of the promises, and we have promised the American people something that is unpayable.
Excellent point. Thank you.
So a few comments on the Trump presidency. Without getting political, I will just say one of the things that I think everybody can agree on is Trump likes to swing big. The one thing that has been apparent of this administration is they are going at lightning speed. So, even things like laying off, nuclear people who are responsible for the nuclear stockpile and then like hiring them back like a week or two later, or whatever that fiasco was. So one thing, one strong conviction I have is that Trump is going to do a lot. We can argue about whether the things he's doing are good or bad for the economy, but the quicker you go and the bigger you go, the more likelihood there is to break something. So that's really what worries me. The tariffs are a big opportunity and a big risk. I do totally agree that certain countries have taken advantage of the US. Being very sudden with it and saying, hey, overnight, we're going to have 25% tariffs is probably not, I guess it depends on your negotiating philosophy, but there is a big risk with doing it that way. And I don't think Wall Street has been relatively calm the past month. I don't think Wall Street is factoring in that a lot of these things are going to be put on, and at the size they're going to be put on. The things that Trump threatened, at least in regards to Mexico and Canada, have been delayed for a month of study. So I think everybody is saying this is Trump negotiating. But at some point, somebody might call him on his bluff. And if he caves, he's not going to look very credible. So one of the dangers I see is that somebody calls him on his bluff. He doesn't want to cave, and he goes big or even bigger than his rhetoric. And then that really could break something in terms of a relationship with the country, or in terms of just creating inflation in this country. Can Dodge do anything meaningful? One thing that was funny that came out recently was they said they saved $50 billion, and then they were going to send every American, $5,000. Well, if you just assume that, they're just sending it to, say, heads of household, say 100 million, and they're going to send $5,000 to 100 million people, that's just deficit spending once again. So unless the big problem with doing, and by the way, I'm totally for reducing waste. I know there's a ton of it, et cetera. I'm not sure that a extra government foreigner is the right way to do it. But certainly everybody agrees there's a lot of waste in Washington. The problem is the big line items in our budget, things like defense, entitlements, et cetera. Very few people are talking about making a meaningful dent. So, you could solve Social Security in an afternoon if you wanted to. It was never meant to last as long as it did. When it was first created, the age at which you got Social Security was beyond people's life expectancy. It was literally old age insurance. So you could, rectify Social Security very easily, but nobody has the political stomach to do it. Like I said, little interest in tackling entitlements. One of the things Trump floated during his campaign, which has not really been in the news as of late, is lowering taxes on corporations. And as we saw earlier, corporations, especially the big ones, the bigger you go, the more extreme it is lowering taxes on corporation would further exacerbate that imbalance that we saw earlier. So that certainly would not be a solution to getting the country more on sustainable footing. And then the financial press is increasingly worried about the Liz Truss moment. That's what I call I believe it was 2022. Liz Truss was the new Prime Minister of England. She put out a budget that they were going to increase spending and reduce taxes. And the bond market literally overnight said no. Long-term bond yields in England fell, not yields, long-term bond prices. So the value of the bonds fell about 30% overnight. And in the morning, people emailed the Bank of England, pension funds, endowments, and said, if you don't intervene in the bond market today, we're closing today's market insolvent. So the Bank of England did what they had to do. They printed money, and Liz Truss lost the premiership of England, I think, in something like 90 days, 60 or 90 days. So, you hear the term bond vigilantes. Nobody knows what the breaking point of the bond market is. At some point, Wall Street may decide hey, we don't believe that the Treasury is not going to is going to stand by our debt the way it stands, some sort of default, not a complete default, but even a partial default, and that's when the bond market could rebel, and that would be a huge shock to the system.
So a couple of things I want to recap. So we have the Trump 2.0 presidency. Again, politics aside, he swings big. He talks even bigger. He's got this threat on the tariffs out there that we don't really know which direction that goes. If somebody calls him on it and he doubles down on, a stubbornness approach, that could blow up in our face, because that would immediately impact households, because it would impact inflation. Dodge, which is the Department of Government Efficiency, although there's a good part about it, which is that we are looking at some of these things. What they're saying and what they're promising could basically just be moving dollars from one place to another, which isn't going to solve the real problem. And more importantly, even the Trump administration doesn't seem to want to tackle the large entitlements because they would be grossly unpopular. Is that a good summary?
Yeah, I think that's spot on, Terry.
And then the lowering taxes on corporations. So remember, taxes are typically tied to corporate profits. And if I now, on top of the fact that the corporations are making profits, if I lower my tax income from that, that is going to further destabilize government income, although the corporations are going to be happy.
Yes, they would be happy as long as there wasn't any instability in the treasury market. Because remember that all of corporate debt is priced off treasuries. So if we have a list trust moment and treasuries go berserk because people are looking at the country's finances and are not confident in it anymore, that automatically plays into the corporate debt market. So it's a balancing act, and what we know is it's incredibly out of balance. And instead of moving more towards balance, a tax cut on corporations would move the needle further out of balance.
Excellent. That's a great summary.
So, to sum up, we've had the best capital markets party ever. I mean, when you look at 2021, we had the highest prices on the stock market ever for the US. Chinese real estate got to $70 trillion in value. We had $18 trillion of negative yielding bonds, which all that means is bonds were the most expensive they've ever been. And we have data going back 5,000 years, back to Babylonian days. Unfortunately, when you look at history, the hangover is roughly proportional to the size of the party, right? Because at some point, that upward spiral starts going down, and then debt, inflation, bad management all reinforce each other to create pain, which is exactly what we had in the 1920s and 1930s. In 1920s, we had the biggest party up till then. And then when it started going back in the other direction, not only did we have the natural hangover from the bubble, but it was poorly managed, and that's what gave us the Great Depression. So now I'm gonna switch over to kind of what can you do as a business owner. The point of the previous section was not to say something bad is going to happen imminently. The point of the previous discussion was more that do not use the last 15 years as an example of the resiliency of your business model, of your investments, etc., and kind of rest on your laurels and not be very, very mindful of risk. Because I have very high conviction that it is, the future will have a negative correlation with the past, and we are going to have a lot of issues over the next 15 years. Charlie Munger, who's probably my hero, he said, I spent most of my life anticipating trouble, and it hasn't made me any less happy. A lot of what I'm going to talk about today in terms of leadership and in terms of managing a business is the Berkshire Hathaway mindset of don't try to predict bad times, just accept that over a 40-year career, you're going to have, probably 4 or 5 times when things get really, really bad. and maybe 8 or 12 times when things get somewhat bad. And you need to build your business to be resilient enough to not only survive those times, but actually take advantage of them. This is Edward Deming, the father of total quality management. He had a great quote that said, "In God we trust, all others bring data." And what he was trying to articulate was, for a business, your data and your numbers is really like your instrument panel for a pilot. You cannot be in a storm and fly a plane well without a accurate instrument panel, right? When you're in the fog of war, you can't know how to react unless you know where you're at in terms of your numbers, where your revenues are, where your profit margins are, where your break even is, right? All these things are really, really instrumental in terms of flying the plane, and the time to do the work to get clear KPIs, good numbers, get your P&L organized, et cetera, is before the battle happens, not during the battle. One thing that a lot of small business owners don't think about is operational and financial leverage. So that's the idea that if your revenues go down by, say, 5%, you have certain fixed costs in your business that are going to stay the same no matter how much revenue goes down. And then if you have debt on the business, then that exacerbates that leverage even more. So what is a really interesting and important exercise to do before there is a big downturn is to understand how much embedded leverage there is in business. In essence, how torqued, how levered is the business to the revenue line item? Because for some businesses, losing 10% of revenue might not be a big deal. You're just making less money, but you're still highly profitable and chugging along. Whereas for other businesses with slim profit margins, high operating leverage, high financial leverage, a 10% drop in revenues can mean, you know, the end is near.
And so for our ShiftCo members, one of the pathways that we offer is called financial basics. If you're not exactly sure, you know, you're like, oh, I need to know my numbers, but I'm not exactly sure. I get the financial statements, but I don't know what they mean. If that's the case for you, please reach out to your mentor and talk to them about financial basics, because we're here to help you make sense of the numbers. I jokingly say I was a classroom English teacher that got into business, and most of my career I didn't know how to read my financial statements. And then I became an entrepreneur and almost killed my first company because I couldn't read my financial statements. And then from that point forward, I muscled down and learned them. And even as a former English teacher, the way that you can understand it is in the financial basics pathway. We break it down into very simple things. You know, you're selling peaches, and we make it really, really simple for you to really understand. But you do need to understand, if revenue were to drop, what would that do to your net profit? And then what things can you do now to prepare that revenue might drop so that you can get both your P&L and your balance sheet in order?
Well said. And I would say there's a CFO that I'm friends with. One of the things he said is, if your numbers aren't telling you a deep, rich story of what is working and what isn't working in your business, then you don't understand your numbers well enough.
100% agree with that.
So another point I like to make is, you know, your balance sheet is the heart of your company. A lot of people worry about profit, which is obviously important, but your capacity to take pain is really tied to your balance sheet. So with a strong balance sheet, you know, there have been many companies that have negative earnings, that had losses for years in a row, and still survived because they had a strong balance sheet. With a strong balance sheet, you can qualify for debt, for loans, to increase the spending during bad times. You can pick up and retain talent who want certainty. So if you are in an industry that has been particularly hard hit during a downturn, and you can tell people, we have plenty of capacity on our balance sheet to take pain, and we are going to be around no matter what for the next 4, 5, 6, 10 years, then talent will be more attracted to your firm than other firms. It also allows you to go on the offensive. So the best deals are made in the worst of times, right? Think Warren Buffett is the poster child for this. What was he doing in late 2008 and early 2009 when everybody was cowering, just trying to survive? He was writing multi-billion-dollar checks to General Electric, multi-billion-dollar checks to Goldman Sachs. Why? Because he had a really strong balance sheet and he was able to go on the offensive, and people were willing to pay very, very high prices for his capital. And then you can outspend the competition on competitive advantages. So, this is the idea that you have something in your business that you're very good at that is your competitive advantage, and being able to organically invest in it during bad times when others are probably not can allow you to leapfrog competitors during those bad times. Any comments on that, Terri?
Again, I think I would just say to our members, financial basics, we focus more on the P&L statement, but I 100% believe what Loic is saying. And in most cases, the balance sheet is probably something you look at every now and then and you don't know what it means. If that's the case, please reach out to your mentor, because we have resources on the coaching staff that can help you understand what your balance sheet looks like in the simplest format. It's a way to think about how healthy is your business, which is why he's got that picture of the heart there, and whether or not you have the assets to survive if you had a downturn, and you compare the balance sheet with your profit and loss. It lets you know how much wiggle room you have in your business. So that's just kind of a layman's term for layman's explanation of what he's talking about.
And I would say, just a thought I had while you were giving that explanation, is for a lot of small business owners, the balance sheet of the business is the combined balance sheet of the business and your personal reserves. Like if you look at my business, I don't keep a lot of cash and money in my business, but I have a lot of reserves invested in such a way that if my business really took a hit and I needed to fund my business, I have things that I can draw from that I know won't lose a lot of value during a downturn to fund my business. So it is a little bit more nuanced with small business owners, because you got to look at the combined balance sheet of the business and the individual to come up with what your combined resiliency is.
Excellent point. Thank you for making that.
So, when you look at who I certainly believe that Buffett is the GOAT in investing. I don't think anybody comes close. And when you look at what Warren has been doing in recent times, this chart goes back to 1991. This is in dollar terms, so it's a little bit misleading because obviously Berkshire has gotten bigger and bigger. But even on a percentage of assets basis, so factoring in that Berkshire is a much bigger company than it was 30, 40 years ago, Warren has more cash on his balance sheet. Getting at what the Berkshire Hathaway letter is being released tomorrow morning. We'll see where he's at. But as of the last report, he had over 30% of Berkshire, over $325 billion in cold hard cash. Now, I sincerely believe that part of that is because valuations are high. He's not finding anything cheap to buy. But it also could be he's seeing something nefarious in the economy that the rest of us aren't seeing. That I don't know. But he has certainly made a public statement to say, I am being uber cautious for this time period.
Absolutely.
So another point I think that I like talking to business owners about is that hope is not a strategy. What I mean by that is, and I see this a lot in my business in the financial advisory world, where people say, oh, stocks for the long run, and then they just kind of cross their fingers hoping there'll never be a recession or another big bear market. Well, again, if you're going to be a long-term investor, you're going to have bear markets. It's not a question of if, it's a question of when, and you're going to have multiple throughout your life. Well, if you're a business owner, you should just accept the fact that there's going to be multiple recessions, possibly, again, over a 40-year career, probably 2 or 3 or 4 really tough ones, and maybe another 4 or 5 kind of what we call soft landing, mild recessions. And instead of hoping they don't happen, being proactive and developing a game plan for when they happen, again, ahead of the fog of war, can be a really healthy exercise. So I would really advise a management team to do this after they've organized their numbers and they know where they're at in terms of their P&L, their profit margins, their leverage, et cetera. And then you can come together with the team and say, okay, we have a mild recession and it's short. What are we going to do? Well, we're not going to give out these bonuses. Maybe we're not going to do this, research and development, whatever it might be. And then you can get progressive, because there are things that you may need to do in a really big recession that you wouldn't imagine doing today. And one of the things that this exercise would do would be, before you enter the fog of war, is having metrics to say, okay, if we lose this amount of money, we need to make this cut. And we know it's going to be painful, but given what we know now and being unemotional about it, because we're not in the middle of it, we are planning for possible bad times. You can make a much less emotionally charged decision and say, if it gets this bad, then we're going to do these cuts. If it gets even worse, then we have to make these more drastic moves and have that game plan. Even if it's a 2-hour session with your management team, just having the big picture somewhat organized can be a lifesaver.
And then for those of you that don't have a management team, your mentor can be somebody that can brainstorm this with you. We have coaches that can help you with this. And your mentor or coach can help you with a management team as well. But this is a great tool to be preparing for all of the things that could happen. I really do believe 2025 is going to be a very interesting year, economically, politically, energetically. I think a lot of things are going to happen. And this is a simple but clean way to prepare yourself to be ready for any of the unknowns that could unfold this year.
Yeah, just to give an example of what that with my clients. So we're at the highest valuations of all time in the stock market. I literally have a spreadsheet and I walk all my clients through it and I say, what happens and what do we do if the markets fall from the highest all-time valuations that we're at today to the lowest of all time? And I show them, we would probably wait for the markets to drop by a certain amount, and then we would start investing slowly but gradually. And then when things get cheap, then we're investing a lot more. And I'm not hoping that the markets don't fall. I'm saying the odds of them falling at some point, at which I can't time, is near 100%. But we have an action plan to take advantage of the fall when it gets here.
Excellent.
So there's a great book out there. It's kind of a cheesy title, but it's called Double Your Profits in 6 Months or Less by Bob Pfeiffer. The way I came across it was I was reading about 3G. 3G at one point was the biggest private equity firm in the world. They are the people who bought Kraft Heinz with Warren Buffett. They also own Burger King, Tim Hortons. They own Anheuser-Busch. Like these are some big dogs. And they call this book their Bible, and it's got some dated examples, but really what it is the mindset. And it's a mindset against the status quo and re-examining everything. So he's got 78 little chapters, and I'm not going to go through all these, but it's things like, are there are a lot of times there are things in a business that hit your credit card every month that nobody is looking at and aren't really needed, or could be modified or just temporarily interrupted. Like I've got this data set that I really like, and it's not that expensive. I think it's like $75 a month, but I only need it every once in a while. So I sign up for it for 1 month. And as soon as I sign up for it, I cancel it. I have it for the month, and then I buy it again the next time. So I'm paying my $75 every so often. Things like unnecessary business travel with Zoom today, that's something you can really limit. Perks that you want to give in good times, you can really understandably pull back in the bad times. I remember my dad was leading a company 20 years ago, and they would have a big Christmas party that was a 6-figure event. And one year he just told the whole company, hey, we're not having a Christmas party. And people complain. He said, look, I can either start firing people or we can not have the Christmas party. And everybody was like, yeah, no problem. We're fine with not having a Christmas party, right? So there are a lot of things that are nice to have, and that you can revisit. And then going back to that game plan I was talking about earlier, you can decide how bad things need to get before you start making those kind of cuts.
Excellent.
This is just more bullet points on it. Again, I'll just flash it on the screen. I'm not going to go through these one by one, but I highly recommend picking up the book, not to read it word for word, but just to scan the 78 chapters and the philosophy that he has around, and then for a few chapters that really hit home, you can read it word for word, but it really helps in building a mindset to reduce waste, be lean and mean for whenever these bad times come. And I think that's it, Terri. Oh, a few more. Again, I'm not going to go through these one by one, but yeah, that's it. That's the end of it there. So, Terri, happy to answer any questions if you have any more.
What's the best way for people if they want to reach out to you to find you, Loic?
So happy to connect, answer any questions. My personal or my work email is Loic, Loic, at Opus Wealth, OPUS Wealth.net. And any friend of Terry's is a friend of mine. Even if you just have some random questions, I'm happy to be a resource and put out some goodwill into the world. And yeah, happy to help however I can.
Awesome. Thank you so much. And then I'll just circle back to where we started. What we just went through today goes hand in hand with the Conscious Business Forecast that we released the summary presentation this week, and we'll release the full report, which really talks about the differences in traditional businesses and conscious businesses and what the world looks like for conscious businesses. But the point is what's happening in the economy and what's happening with the government really does affect all businesses, and we need to be prepared for that. And I don't think we need to be afraid. To me, it isn't just about what I believe politically. It's just really about preparing my business for the inevitable challenges that are coming and trying to insulate so that we stay as healthy as possible. So Loic, as always, I appreciate your expertise and appreciate the time and you sharing your wisdom with our community. And we'll probably have you back this time next year. We can see how things look a year from now.
I'd be happy to.
Thank you.
Thanks, Terri.